My name is Rohan Singh, and I'll be conducting a number of short videos to assist you in studying for your life insurance licensing certification. The first segment that we're going to talk about today is term life insurance. Now, term life insurance is actually a fairly simple product. It's the simplest product that life insurance companies offer. And simply, the insurer promises to pay a death benefit if the person that's insured dies within a certain fixed term. And so term insurance primarily covers only a death benefit. It's pure risk coverage. You're not able to accumulate any additional savings. It's simply risk coverage. And as long as you continue to pay your premiums, the insurance company is going to keep that coverage in force. What's interesting also is that your premiums are guaranteed. They quote you a premium, and that's going to be the premium you're going to pay for the term that you have. Now, typically, term insurance, you can purchase it for terms of 1 year, 5 years, 10 years, or in some situations up to a specific age, for example, term to age 65. Coverage usually on term insurance terminates between age 75 and 80. So you can keep it for that up to that age, but beyond that age, you're not able to carry on your insurance product. Now, we're going to talk about permanent insurance, which covers you for the rest of your life. But when we talk about term insurance, it again is for a very specific term. In many cases, insurance companies will not issue new term insurance policies beyond age 65 or 70. So, again, in its simplicity, you can buy a term insurance policy on your own life, one life. You can buy it on your spouse's life. You can buy it on your business partner's life, but it will cover that one life and will pay a death benefit in the event that individual passes away. Now, additional flexibility with term plans is they actually allow you to cover more than one life. We call those multiple life policies, and you'll see them referred to as joint life policies. Now, there are two types of joint life policies. There's a joint first to die policy and a joint last to die policy. And as the title indicates, joint first to die will have more than one individual covered, and whichever individual passes away first, that's the one, the death benefit will be paid. And so if you think about, well, where can I actually use that type of a policy, you might want to think about a couple that has a mortgage, and both of them are working and contributing financially to the payment of the mortgage. And so if anything happens to one of them, it would be really a good thing that the mortgage could be paid off. So normally couples will have a joint first to die mortgage insurance policy. And so that it's term insurance because it's covered for the term of the mortgage. But in the event that either party passes away, then the payment is made right away and the mortgage is paid off. The second type of joint policy we have on term insurance is joint last to die. Now, this is a very interesting policy because it's for a very specific use. And as you may or may not know, and you will find out as we learn more about the life insurance industry and taxation and issues that we have that insurance policies can address, you will learn that when our assets pass from one generation to the next generation, there tends to be an obligation to pay taxes to the federal government. And so people that have, wealthy people that have assets, investments, they may have investment property, they may have stocks and bonds. Eventually, when those assets move to the next generation, there's going to be a liability to pay tax. And a joint last to die policy pays out the death benefit after both spouses, for example, pass away, and assets are then left to the next generation, and that's the time when the taxes are going to be payable. So we can use joint last to die term insurance for that specific application. Now, let's talk about some of the death benefit options. As you know, with insurance, you pay premiums for an insurance policy and you purchase a death benefit. And on term insurance, there are actually 3 levels of death benefits. You can have a level face amount. We use the term face amount or death benefit. Means the same thing. It's the amount of insurance coverage that you have. And so term insurance plans allow you to have a level amount, a level death benefit for the duration of the term that you have. You also can have a policy that is a decreasing death benefit. And that's the example I used earlier, which is mortgage insurance. As you pay off your mortgage, your principal that you owe decreases. And so mortgage insurance is technically decreasing term insurance. The balance that you owe on your mortgage is directly equal to the balance that's the death benefit that is in your decreasing plan. So again, decreasing term insurance usually used to cover mortgages, or could be for a line of credit. It could be a short-term loan that you have. And so the death benefits matches what you owe on the balance of your loan or mortgage. A third type of coverage is increasing term. So increasing means the death benefit actually increases each year. And as you know, we are all living in an environment where inflation impacts us. The cost of goods in the future is more than it is today. And so an increasing face amount policy increases usually by the rate of inflation. And so we say it provides a hedge against inflation. So today, if I needed $200,000 of coverage, in 5 or 10 years, that same $200,000 is not going to have the same purchasing power as it did 10 years ago. So I may want to have coverage that's indexed and increasing each year to keep up with the cost of living. So our premiums now, as I said, premiums are what we pay for our insurance. It is usually level for the term of the insurance. So insurance company, let's say you want to buy a 10-year term policy, the insurance company will quote you a premium that is the same premium for the next 10 years. At the end of 10 years, when your term is over, then your policy is over. Although we're going to talk about in the next segment about some renewability features that term insurance has. So again, your premium is level during the term. You can choose to pay your policy premium annually, one premium up front, or they allow you to pay it quarterly or monthly. In addition to that, provinces have a premium tax. So when they calculate your premium, depending on the province that you are residing in, the insurance company will add a premium tax to that cost. Now, one other point that's important, as I mentioned, term insurance provides you with basic term coverage. And the premiums that the insurance companies are collecting from you are enough to cover a term we refer to as mortality costs, the cost of dying. Insurance companies do studies, and they in fact have to understand how frequently people of certain ages pass away, so that they want to make sure they're collecting enough premium and they have enough money in place to pay out those death benefits when they occur. So we refer to that as mortality costs. So when you look at a life insurance premium for term insurance, it has 2 components. It has enough money to cover the mortality costs, and in addition to that, the insurance company is running a business. They have expenses. They have selling expenses. They need to have you medically underwritten to make sure that you're healthy. They have administration. They have staff. They have claims that they have to pay out, and they also want to make a bit of profit. And so when we look at term insurance, the premium is made up of 2 basic components. Number 1, enough money to cover our mortality cost, and number 2, enough money to cover the operating expenses of the business. In addition to that, as we get older, it's understandably we get less healthy, and because of that, as we get older, the cost of insurance goes up. If you are young and in your 20s, then it's going to cost you an awful lot less for $1,000 of insurance than if you were in your 60s. So our cost of insurance goes up as we get older.